So welcome to class. Christine, welcome. We are still in the paper of September 2021. Still in the paper of September 2021. We're still in that paper. And we are dealing with question 4. Dealing with question number 4. So question number 4A. Question number 4A says, explain the differences between standard costing and target costing. Standard costing and target costing. That is question 4. We are told to explain the differences. To explain the differences. So we have standard costing here. Standard costing. Target costing. Target costing. We are told to explain those differences. And the first one is that a predetermined, number 1 here, a predetermined cost. A predetermined cost is set first, using historical information. Using historical information and subsequently the selling price is set. The selling price is set. That is what happened. The predetermined cost is set first using historical information, and subsequently the selling price is set. On the other side, product design product design concept involves setting the targets, the target selling price, first and subsequently. Selling price first and subsequently ensuring that the target cost, achieves the target profit margin. So that is basically what we mean by, or the first difference between standard costing and target costing. So here we set the cost first, then we get the selling price. But here we first of all set the selling price. If I told you, you get the selling price, then you subtract the desired profit so that you're able to get the target profit margin. The second difference is that number two, maybe I could separate. I could create a separation gap here. Then we say that this one ensures that costs are kept. It ensures that costs are kept within predetermined standard limits or standard values, So costs are kept within predetermined standard limits. But on the other side, ensures costs are kept within required or target limits. Within required or target limits. That is the second difference. So here in standard costing, we talk of standards, but here we are talking of limits. Another one is that standards are revised annually. But on the other side, it is continuous. It is a continuous cost adjustment program. It's a continuous cost adjustment program. So it's not something that is annual. It is something that is continuous all the time. Okay, so I think that is good enough. Now, for those who have just read it, we will advise them maybe to beat the photo or to watch the video later. I should also start there to beat the photo. See, so we proceed. Question 4 again. Question 4. And now we are in question 4B. Question 4B says, describe 3 main challenges encountered in environmental management accounting. 3 main challenges encountered in environmental management accounting. The question is about challenges in environmental management accounting. And if you remember, when we covered this bit, I told you, going by the past history, the probability that there will be no question in your exam on this area is almost 0. Since this area was introduced, the examiner has been very keen to bring a question in that small bit. So one is, we always experience what we call inadequate links between accounting and other departments. That is a major headache. For you to be able to get these figures and even to then communicate what should be done, you find that there is always a weak link between the accounting department and the other departments, and that greatly weakens. The other one is unintentional hiding of environmental. Sorry, that one should be intentional. Intentional hiding of environmental related costs. Environmental related costs in overhead costs. So you find people are aware that those costs are environmental, but intentionally people want to hide them. So there is intentional hiding of those costs there. And now, as the management accountant, it becomes very difficult to be able to pick out those costs. It becomes very difficult. Another one is inadequate tracking. Inadequate tracking of environment or environmental related costs. How do you track those costs? Like now what you are saying about these hazards, being a tree that was cut down. How do you track from the tree being cut down, the oxygen has been affected, rainfall patterns, all the way to when we are using these machines, these papers, then they are thrown to the dustbin, they go to the dump site. How do they affect people? All those kind of issues, it may become very difficult to track. Something else is lack of environment-related information. Lack of environment-related information. People are not aware. People are not sensitized that what you're doing could be harmful to the environment and so on. So even when you want now to do management accounting as far as the environment is concerned, it becomes a limitation. Good. So from there, let's now go to the next bit. The next bit is question 4C. Question 4C. It says that the following details show the direct labor requirements for the first 6 batches of a new product that were manufactured in the month of August 2021. We have the output batches, we have the labor hours, we have the total labor costs, and then the management accountant reported the following variances: total labor cost variance of 315,000, labor rate variance, which was 0, labor efficiency variance of 15,000. The production manager has now said that he forgot to inform the management accountant that he expected a 90% learning curve to apply for at least the first 10 batches. You are required the planning and operation of variances that analyze the actual performance, taking into account the anticipated learning effect. The learning index for 90% learning curve is minus 0.152. Okay, so that question is on what I told you the other day is called ex post variances. Is on ex post variances, ex post variances, and running curve, and running curve. And I told you that, first of all, we have to use the running curves. We have to use the running curve. And when we are in running curves, you must know whether you are using the average or the total approach. That is what you say. So in this case, it is the total. So you proceed and say, using running curve, total method, using running curve total method, you begin by writing the formula that y is equals to ax b plus 1. Y is equals to ax b plus 1. Now we start identifying those items, and b, you know so well, is given as the log of r. You divide by the logarithm of 2. The log of r, you divide by the log of 2. Now, the log of r, we are told the running curve, according to the question, is 90%. 0.9, you divide by the log of 2. Now confirm whether this is minus 0.152. Okay, then we look for x, or first of all, we look for A. A is the time required for the very first, and the time that is required for the very first, you will go to the budget. You can see the budget was to make 2,400 units. The output was 24. Sorry, the output was to make 6 batches. And the total hours were 2,400. So if you want to know one batch was taking us how many hours, you divide 2,400 by 6, And that will give you how many hours? That will give you 400 hours. 400 hours. 400 hours. And then the actual is also 6. So for the actual, maybe we also needed to have said b plus 1 is minus 0.152 plus 1. That gives us what? 0.848. 0.48. So for the actual, X is equal to 6 batches or 6 units. And because the very first unit is part of this, so that one we just go straight and say Y is equal to 400 multiplied by 6 raised to power 0.848. Raised to power 0.848. What is the answer? You're getting 1827.8. So this one we could call them 1828 hours. I hope they will not affect the conciliation so much. So with that now, we can start computing those variances. We can start computing those variances. And we start with total labor cost. I think that is the one they have given there. Total labor costs variance. Total labor cost variance. So I told you that we have the convention. According to the conventional, total labor cost variance is given as standard labor costs minus actual labor costs. Standard labor costs minus actual labor costs. And this is the one that is already computed for us. That is already computed, or maybe we that is already computed for us and given as 315,000. 315,000. So that is already given in the question. Now in the expos, I told you the convention of variance. The total labor cost variance will be given as the planning element or the planning variance plus efficiency variance. Efficiency variance. It is given as the planning variance plus efficiency variance. Now, how do you get planning variance? Now, planning variance is usually given as the standard labor costs, you minus the expected labor costs. Minus the expected labor costs. The expected labor costs. Now, this is where I was telling you here, if it has rained and you did not expect that there will be rain, and you have paid more in terms of the fare, when you go home and they start questioning you, they will ask you, why didn't you opt to remain in the school for a while? Why didn't you opt to remain in the corridors of the streets for a while? Why couldn't you negotiate with Makanga? Why couldn't you walk a little distance? So that is now what we are saying it is expected. So according to our question, the expected, rather the standard is 1680. 1680. Remember, the other one for standard is the word expected. I think we have been talking of how that is connected. Then, when we come now to the expected, we will argue this. According to our budget, we should have spent 1680. And this one was to be enough for 2,400 hours. 2,400 hours. But sasa kulingana na ile computation tumefanya hapa ya running curves, the hours were not supposed to be 24 hours, 2,400, but they should have been 1828. 1828. So give me that. How much? 400, 400. Favorable or adverse? Negative or positive? So kama ni positive, kumaanisha the expected was less. So that is favorable. Let's now get the efficiency variance. efficiency variance, efficiency variance. Efficiency variance is given as expected labor cost, you minus actual labor costs, So the expected, we already have it as 16,800, which is divided by 2,400, multiplied by 1828. Multiplied by 1828. You minus, yes, that done. Let's see. You minus the actual. That's how we get what the actual results. Uangalie actual labor cost was 1365. 1365,000. $400. So kama ni negative, that is adverse, because kumaanisha actual is higher than the expected. So the total variance will now be equal to, according to this formula, is the planning plus the efficiency. So the planning is 400 favorable plus 85 400 adverse. Check whether it is taking you back to be 15,000 favorable. This one should have been favorable. So this is what I told you. Instead of punishing everyone, or rather the person based on the total variance, the 315, which is favorable, you need to break it down into two components. One is planning, and we said planning is beyond control. Efficiency is within control. You see, any manager who was relying on the conventional variance would have rewarded this guy because he reported 315,000. But in actual case, he should have been punished because what was within his control, he reported an adverse. You see that? He reported an adverse, so he should have been punished. So I think that is clear now. So we do the same thing now with the next one. The next one given there is labor rate variance. So labor rate variance. Let's do the labor rate variance. Labor rate variance. So in the labor rate variance, conventional labor rate variance is given as what? Standard rate and maybe something else I needed to have clarified for you better understanding. Ukiangalia conventional, the formula is standard minus actual. Standard minus actual. You see now what we are doing, we are just introducing a new element we are calling the expected. Naona hapa imeingia ikiwa negative, na hapa inaingia ikiwa positive. That's why when you come to combine them here, they cancel. hii expected goes away, tunapata ile tulikuwa tunao hapa juu 315. That's how the plans. So this one huwa tunasema ni standard rate minus the actual rate. The actual rate you multiply by actual hours. And this is the one that in the question we are told it was computed and found to be 0. That's all. It's found to be 0. So we come now to when we are in the ex post, the total, or rather the labor rate variance. Labor rate variance will be the planning variance plus the efficiency variance. So how do we get the concept is the same. It will be the standard rate. The standard rate you minus expected. We are just introducing expected. Expected rate you multiply the difference by actual hours. You multiply the difference by actual hours. So Sasa, let's get the standard rate. Now the standard rate is what we had said. It is 16,000. You divide by 2,400. And why standard is agreeing or is the same that is in the budget? I told you the difference between standard and budget is that standard is given per unit and budget is given for all the units. Now, if you want the budget and you have standard, you just multiply the standard by the total units. If you have the budget and you want standard, you just divide budget by the units. That therefore means if the units of actual are the same as the units of the budget, the standard cost and the budget cost are the same. Sasa ukiangalia kwa hii swali, the batches that were budgeted, they are 6, and the actual units they were also 6. That's why you keep on seeing that I'm writing standard, but nakipia kwa the budget. See that, So, sasa tuende kwa the expected. The expected rate should have been these 16,000. You divide by the hours that we expected we should have used, 1828. Then multiply by the actual hours. The actual hours, ukipia huko kwa the actual results, unapata ni 1950. So work out that and give me the answer. What's the answer? 427. 427. 123 negative, eh? So kama ni negative, that is adverse. That's adverse. Haya, tukuje now kwa the efficiency. Efficiency, it will be the expected rate. Expected rate minus the actual rate. Actual rate you multiply by actual hours. Actual hours. So the expected rate, we already have it at 16,800. You divide by 1828. The actual rate, we simply get the actual cost. The actual cost was what, 13,65,000. 13,65,000. You divide by the actual hours of 1950. 1950. You multiply by the actual hours of 1950. Yeah. 427, 123. Okay. So now when you come to combine them, you will have 427, 123 adverse plus 427, 123 favorable, and that gives you what? 0. That gives you 0. We go to the next one. Labor efficiency. Labor efficiency variance. So if we start with the conventional, you know so well that when we are in the conventional, for the efficiency, we say standard hours. And this one is actual. And I hope you still remember that the word conventional is used to refer to what is normal. Ile ya kawaida, what we normally do. Yeah. That's what we call convention. The routine. Now, the labor efficiency variance here. Labor efficiency variance is standard hours minus actual hours. And the difference that we are going to have is this one, which is given at 315,000, which is favorable. 315,000, which is favorable. Good now for the planning. Planning again, you can see the format of the formulas. This is the standard hours now minus the expected hours. Minus the expected hours. So the standard tumekuwa tukisema ni hizi za budget, which are 2,400. Minus the expected hours, the one that we computed, 1828. So work out and give me the answer. What is the answer? $11, $15, $400. Favorable advance. Favorable. Because you should have used or we should have used fewer hours. Sasa hii nayo unakujua maneno so that you talk of the expected hours, actual hours. So the expected hours are 1828. Actual hours ni 1950. Oh, there's something here that we have missed. The formula here is always standard rate. But we always use standard rate. Just changing the hours and thinking it is that direct. Always use the standard rate. So the standard rate is, I think it's what we had computed earlier on. The 4, was it? No, not 400. It is 1680. Divide by 2400. Nakuja ngapi? 1680 divided by nakuja 700. Yeah? 400, favorable advance. Favorable. So sasa tukuja hapa, we do the same thing. This is 16,800. You divide by 2400. Mm-hmm. 5,400. Favorable adverse. Adverse. So that the total here now would be 400 favorable plus 85 400 adverse. And this takes us to 315,000 favorable. 315,000 favorable. 315,000 favorable. So That is what was supposed to be done. Any question? Look at the paper of May 2019, question 1B. May 2019, question 1. In your past papers, in a summer AA, eh? But should be B. Can you see that? Can you see it? Is it doable? Now, your friends who are in my class last semester, I solved that for them. Actually, there is another one. That is that one now. Because I think you were there for class. Let me look for the one that I solved. Should be another one. There's also a still one. Can't choose it. But I remember solving the same. Alafu nikawaambia wafanye hiyo kama assignment. So it's only after the exam one student was telling me, mwalimu afadhali mkifanya hata hiyo. But it's basically the same. Basically the same. So these things are the same that comes in the exam. So you just need to do a lot of practice. Good. So with that, we now proceed to question 5. Question 5A, we solved. Is that so? I think it's the question I used when I introduced transfer price. Or it looks strange. So you want me to do? Huh? Sylvia, what do you want? Oh, you do? Is it the books? No. Transfer pricing, when I was teaching transfer pricing, you are on there? Yes, I can see Adam confirming it is done in class. So if you have the notes in class, it is there. So maybe you can look at it later. In case you get started, you can write me. Transfer pricing. You have seen it, eh? Yes, it's there. So see when you tumekubaliana, you look at it. Oh, what do you think? Watu wa mitandao, what do you think? Harrison, Christine. Which one?
The next question in the next sitting.
Or the question in the next sitting is similar. Okay, good. I'm informed that the next question is similar. So we can do the other one. Okay, so then we agree that we skip it. Okay, let's now go to part B. Question 5B. Question 5B. Now we can have who read for us. 5B. So Sylvia, you can read for us.
The standard cost for a certain chemical is 40% material A at 20 shillings per kg, 60% material B at 30 shillings per kg. Standard loss of 10% is expected during production. During the month of July 2021, the actual data was as follows. Materials used: material A 90 kg at a cost of 18 shillings per kg, material B 110 kg at a cost of 4 per kg. The weight produced was 182 kg of wood production. Required complete material.
Okay. Okay. So we compute those items. So the first one is material price variance. And because we have these formulas, you can just write issues. Yeah. So material price variance is given as standard price minus actual price. You multiply by actual quantity. Standard price minus actual price. So you can try that. There's a minute.
E2021 is the one that we show data transfer price.
Because kwenye question umesetiwa umesetiwa, alafu kwenye kama wewe ukua au expect kuangalia tu ushike na hii question usisema tu sasa kichende tu kama kufanya sana
Okay, so Mwalimu says not available for AFM. Has been called to attend to an urgent issue, so he's leaving. Sasa. Okay, so I was saying starting price minus actual price, you multiply by actual quantity. So let's start with the material A. Material A, the starting price of Koju was 20 shillings, but down here it was found at what? 18, and the actual kilos that were bought were 90. So that gives us 100 what? 80, which was favorable or adverse. It was favorable. Then for material B, it was supposed to be bought at 30, and then they got it at what? At 34. And the actual kilos that were gotten, they are 110. They are 110. So how much is that? Huh? 440 advance. 440 advance. So if you can even leave it that way, or you combine. So if you combine, you will be left with what? $260 advance. $260 advance. The next one is material mix variance. Material mix variance is revised mix minus actual mix. You multiply by the starting price. Revised mix minus actual mix. You multiply by the starting price. And starting with A. You can see the mix was 40%. A was bring 40%. So that is 0.4 of the total. The actual total is this 90 plus 110. That gives us what? 200. So A should have brought 40% of 200 minus what it actually brought, 90, at a starting price of 20. At a starting price of 20. So that becomes what? 200. And that is advanced because we used more than what we should have used. When you come to B, it was supposed to bring 60% of the 200, but it brought 120 at the start price of 30. 300 favorable. So if you combine this, then you'll be able to get 100 favorable. 100 favorable. Hiyo ingine tunaulizwa is materials yield variance. Materials yield variance. Tulisema is standard yield minus actual yield. You multiply by standard material cost per unit. 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 That being the case, I told you when we are talking about the yield, we are answering the question of how many units did we get out for every 1 unit we input. Now in this question, the units of input are given as percentages. So tuliweka 40% of A, tukaweka 60% of B. So in total tulikuwa tumeweka ngapi? 100. Then there is a statement there that says there is a standard loss of what? 10%. So we lost, that's what in process costing we call normal loss. So we lost 10%. So if we lost 10%, how many did we get? 90. So we got 90 after we had input what? 100. So for every 1 unit, we got, for every 1 unit to make up, we got out 0.9 units. 0.9 units. So if that was to be maintained, you now multiply by the total number of units that you work at 200 minus the actual units that were realized. Tumeambiwa the weight produced was 182. And the standard material cost. The standard material cost, this one we had not computed, but we need to compute now, was for you to get 1 unit, it was supposed to be 0.4 times 20 plus 0.6 times 30. 1 unit, 0.4 of A and 0.6 of 30. So that is what you get out as the yield. So this one must also be divided by 0.9. Must be divided by 0.9. And because that may help us somewhere down there, it may help us in the next computation. 90 over 200 is 180 minus 182. Sasa nipatie hii now. So now 28. Favorable advance. Soma juice. It is favorable because tulifaa kupata 180. Tukapata 182. So if you get more, you go home crying. Go home crying. Okay. Then sasa hiyo iko namna hiyo. And finally, material cost variance. Material cost variance is given as standard material cost minus actual material cost. Standard material cost minus actual material cost. So standard ones again, nimekuwa nikisema that it is per unit. So per unit, it is 28.89. So you multiply by the actual units that were arrived at, that is 182, that is the standard. You minus the actual. The actual, utaenda hapo kwa the actual results, upate that we bought 90 kilos at 18 shillings. And then we also bought 110 kilos, 110 at that 4 shillings. At that 4 shillings. Napata? 102.2 or 02. Favorable or adverse? Adverse. It's adverse. So I think that is good. Okay, so if you're okay with that, now we can close to the paper of May 2021. Let's close to the paper of May 2021. Jane, you can read for us part A. Okay, so you are told, thank you, that's good. You are told that the non-financials could be more important than the financials. So, what do you think? As in, how I handle a question here is more important than how many questions I had in this lesson. Because the how many questions is the financials. Mwalimu amejibu maswali 4 in this lesson. Can we say that if I had one question in explain vizuri, explain lesson ikaisha one question, but kila mtu ameielewa kabisa, is that better than when I had 4 questions in the same lesson? Yeah, what do you think? Maybe you can write some reasons to support this position. Include some reasons to support this position include one, better compliance with long-term corporate strategy. Better compliance with long-term corporate strategy. Since the measures are linked to the strategy. Since the measures are linked to the strategy. So that means that you are able to identify the strategy that you are pursuing. Are you still doing the Michael Porter theory in leadership and management? The ones that talks of focus, differentiation, cost leadership. Then they also talk of the rivalry among the existing businesses, the new markets, the suppliers. Some people are not in class. I'm threatening someone's life. Don't worry, I'm on reciting. You know, when you're near exams, you should not be hearing of new things. Yes. Okay. Okay. So I stop. I told you I have a very strong presence in leadership and management. I have a lot of interest in it. So, yes, Harrison anasema imefunzwa. Good. Yes, Harrison says Mr. Karua has taught. Michael Porter's theory. The competitive forces. Okay, so my point was, once you know which strategy you are using, then the non-financials are linked. The non-financials are linked so that you are able to pursue that. Number two, they help in identification. They help in identification of long-term benefits for the investors. They help in identification of long-term benefits. Long-term benefits for the investors. For the investors. But another one is that they take into account. They take into account intangible assets. Intangible assets. Intangible assets such as customer loyalty. Such as customer loyalty. Another one is that they eliminate cheating in managerial actions. Cheating in quotes. They eliminate cheating in managerial actions. Cheating in managerial actions that are meant to achieve. That are meant to achieve short-term financial goals. Short-term financial goals. Okay, so what we mean by eliminating cheating, it is the use of strategies that are not substantial. For example, there is a common strategy called sale on return basis. Sale on return is where a customer is allowed to come for the goods, but they only pay upon selling those goods. So this is what happens. If we are closing the year, that 1st of December 2021, and the target was to achieve maybe 2 million. But as of now, the actual is around 1.8 million. So as the manager, you have a deficit of 0.2, and you don't want to be found on the deficit side. So what do? You call one of your customers who is a regular customer, and you call this customer around 27th of December 2021, and you tell them to take some goods worth 0.4 million. And you don't even charge them. Now, we are likely to be closing over for the New Year celebrations. And because we're not doing our customer, I don't want to struggle. So, beba hii mizigo hata kama huna pesa, malipo tutalipana Januari. So this customer carries goods. Now, when they carry goods, you recognize them as sales. Remember, in financial accounting, a sale is recognized when the customer assumes risk on the other side, not necessarily when the customer pays. So once the customer has carried the goods from your premises, you include them as part of your sales. So by the time tunafunga hii mwaka, on that 1st of December, then you will be telling us you have an actual of 2.2. That is 1.8 plus 0.4, which now will make you to be a good performer because you have even surpassed the target. The target was 2, now you have 2.2. Some people even go to an extent of agreeing with the customer that ikifika tarehe 4 January of 2022, you return those goods. You can even facilitate their transport. Aende aweke kwake for a few days alafu arudishe. And because the company accepts or rather goods returned is a normal procedure. By the time that zinarudishwa next year, we will not go back to last year to adjust those books. So this manager has already gotten his reward or his honor, if it was to be given based on that. But in actual sense, hajauza. Hiyo mizigo ilitolewa tu kwa store, alafu imerudishwa. Now this one is done for short term, but in the long run, itajulikana. Because huwezi ambia mtu abebe mizigo akakae nayo kwake for more than a year or even several months. Itajulikana hata yeye hana hiyo storage facilities. So non-financial measures, they come a long way in eliminating those cheats or those unethical behaviors. Yeah. Good. So I don't know whether the time that is there will be enough to handle that question. Part B, but nonetheless, sasa tuko kwa Abigail, read for us.
following figure will be the market department will print up the available fortunately, the division will be which is the last 60 members. The manager of the division will be to say division with social praise and proposal unit. The manager of the division will be to rather than sell to the division will accept 250 shillings. The manager of the division will be rather than street activity division to sell of our like this, investments for 120 million plans and that's assets presented this persuasive case showing that the savings 60,000 contribution to assurance to install 55 best interest of the best interest of the country.
Thank you, that's good. That's good. I left out kidogo. So let's seek to get the computation of the required sale price. Let's get that. So this selling price, we are told that it should fetch at 25% on the average assets employed. The average assets which are employed. And the assets which are employed, we are given the average assets as 200, that is the debtors, inventory of 600, and plant of what? 400. So the profit should be 25% of, tumesema ni 200 plus 600 plus 400. Is 300, and the figures are in millions, So 300 million. Okay. Then we bring the fixed costs. The fixed cost, you can see we are told it is what? 400 million. Then we bring the variable costs. The variable costs. The variable costs, we are told it is 1,000 per unit. It's 1,000 per unit. And how many units are involved? The target selling of 200,000 units. Yeah, 200,000 units. So this will be 200. So there, 200 million That is what is involved. So that tells you if you have to make this profit, the required revenue, should be the profit of 300 plus the fixed cost of 400 plus the variable cost of 200, and that gives us what? 900. 900. That is what you should be able to get. So the required selling price. Should then be 900 million. You divide by the number of units, which we are told is 200,000. 900 million, which we are told $4,500. So that is the price they should charge, 4,500. So that's the price that should be charged. So now there are two options here. So we were told that there is an option according to information 2, that division B can buy 60,000 from outside. Can buy from outside. Okay, I think I need to divide it into 3. I have to redraw that. Let me draw that. So we are dealing with transfer pricing analysis table. We have details here. We are told okay, well, there is something I have not seen here. Number 3, it is introducing another option. So you already have divided into 6. That is how ordinarily we normally do it. You remember how we solved that. But now here they are saying, according to information 3, that instead of selling at 22.50, they would rather just remain at 140, and that will have a reduction in their investment. Let me see whether I can combine the two or it will be. I can still combine fixed cost. So division B buys internally and division B buys externally. Yes. So with that, now I will have division A, then I will have division B, then I will have the company here, division A, division B, and then the company. True. So let's bring the sales revenue. Sales revenue. And sales revenue, we can start with internal. 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 So the units at hand, they are 200. That is the capacity of A. And then B has a capacity of 60. So if B is buying internally, it will buy 60. And then external, we are going to sell 100 and what? 40. And we are selling at, if we work with our figures in millions, if we work with our figures in millions, because my space is kidogo. Now that's already nimetoa 3 zeros hapa. Nimetoa 3 zeros, Then kwa hiyo price yenye tulikuwa tumepata 4500, tutoe 3 zeros, tutabaki na 4.5. Space kama kidogo. Share. You can have to separate. First of all, give me that 60 times 4.5, 270. So you get to share 270. Then the external, it is 140 times 4.5. Huh? 6,300. 630. 630. Now we are not told that division B, after they got the product, they are selling it at how much index. We are not told. So this internal will not affect B because B is the receiver, and it will also not affect the company. And similarly, this external is not affecting B, but it's going to affect the company. So we bring 630 there. What will happen if B is buying externally? If B is buying externally, division A will not have internal sales. So they will only sell the 140 because they are saying they will confine themselves to 140 at 4.5. So that is again 630. Na inakuja hapa kwa kampuni 630. Then we less variable costs. We less variable costs. So variable costs, we start with transfer. We start with transfer. Now transfer is going to affect division B, which is 60 times 4.5, and that is 270. And we say transfer price has no effect on the company. So it's not going to affect the company. Here, there is no transfer because B is buying from outside. It's not buying internally. But because of that, there will be another one, the purchase. The purchase. So B is going to buy 60 here. They are going to buy at Tunabiwa, they are going to buy or to make at 2.25. 2.25. Give me that. You can see that in information what? Information 3. $22.50. Let me see that. At 2. Oh, it is also in information 3. Oh, so they are in both. It's the same thing. It's the same thing. Ni 2 ni B anasema nitanunua, or rather I can make at 22. C our information 3 nayo huyu mwingine anasema badala kuuzia at 22. Yeah, the same thing. How much? 135. Now this 135, it is a value that is affecting someone who is outside because you are going to buy. So it should be brought here. The negative. I should have put it here in the same right now. 60 times 2.25 because it's not transfer. I slightly go on the same line. It's not transfer, it's purchase. That's what we are computing. So 135. Then we come to own. Own production. Own production. So the own production is what we had gotten earlier on. The variable cost it is 1,000. Sasa, when B is buying internally, division A will have to make 200. You are 16 now, 140. And now these ones the car 1,000. So that means the cost will be 200. Be 200. Sasa hii hatujaambiwa that B is going to further produce, and this now will come to affect the company there. That will come to affect the company. On the other side, according to information 3, this guy is saying he will now just confine himself to 140. So he will just produce 140 at 1. That is 140. And this one will also be felt by the company. Will be felt by the company. All right, let's now bring the fixed costs. Let us bring the fixed costs. So the fixed costs will be 400 million. It is 400 here for division A. These costs are for division A, 400 million. And division B, have to do anything about it. So this one comes to the company here, 400. Company there, 400. Then on this side, division A would still incur the fixed cost. What he's saying, according to information 3, let's look at it. We are told when he confines himself to 140,000 units, he could reduce his investment by 8 million in inventories, 120 of plant and other assets in selling and administrative expenses. So that means the average assets will come down by those values. Like inventory, instead of being 200, it will now be what? 80, rather it will reduce by 80 and so on. So those ones are not affecting the fixed costs. So here, Now from there, we can also bring, look here, we have two options. The first option is we just stop there, the way we normally do it. Remember how we normally do it? It's exactly like that. Now we get the net profit. The second way, we also recognize these reductions. We also recognize them and bring them here. So if we recognize them, so you say add savings in investments. I either choose to recognize or not. So the savings in investment, they will be what? They will be 80 plus 120 plus 40. That is 80 plus 120 plus 40. That will give us what? 240. And that is now going to who? To division A. Division A. And because it is a saving, it will also affect the company. It will affect the company. So with that now, we can get the net position. Which we shall call net profit. So tuanzie hapa. So chukua 270 plus 630 minus 200 minus 400. 300. This one is 270 minus 0, so we get minus 270. Kuja kwa huyu mwingine what will be the answer? What will be the answer? Because of hapa kwa kampuni it is what? 30. Tukibie nao kwa hii ingine useme 630 minus 140 minus 400 plus 240. 330. Hii itakuwa negative 135. Hii ngoa hizi tatu alafu ongeze hii 40. $195. So what do you advise? It is better for division B to buy externally. You can see the company, the profit for the company is going up by 195. Rather, it's going to 195 from 30. So it is better for them So we stop there for now. Remember, we have said Mr. Wafula will not be available for the AFM.